And welcome back to the Investor Shed Podcast. I'm Nick Beveridge, your host, here with my co-host.
Who am I?
Jeremy Kitchen.
That's right.
You're
Same
supposed
guy.
to say it.
Oh, yeah. Well, you always say my beautiful co-host, so I was expecting some sort of compliment there. And you just didn't follow through, so that's fine.
I mean, I follow through once in a while.
Okay.
Not every time.
Yeah. So now it's in my head that it's not expected for you to call me beautiful. Understood. It's fine. I'm fine.
Hey, if I say it every time, you're not going to appreciate it.
You don't know how compliments work, do you?
Well, you got to scatter out the compliments.
Yeah.
It's like your wife. You can't show her too much affection.
Right.
But every once in a while, if you do, she's like, "Oh, this feels good."
This is
But if
nice.
you did it if you wore her down with appreciation every day, she would get disgusted with you and start cheating on you immediately. That's how wives work.
I think you're pretty close, but you're a little off. You know that sounds like a hard situation. I will say that, having your wife cheat on you, because I'm trying to do a segue here.
Because you're showing her too much.
Right.
Oh, yeah.
Hard.
That would be hard.
Yeah.
Hard money.
Hard money is the topic today, ladies and gentlemen.
Yeah, we're talking about hard money. And we've talked about hard money before, but this time we're going 2.0.
Yeah, this is the advanced version. This is like once you've actually, you're actually serious about a deal, what to expect with hard money and how it all works and how the money flows and your timelines with everything. And it's going to be great.
Yeah. So we've had an episode in the past. Simply called Hard Money.
Yep.
Or something.
And we talk about it all the time, too.
With that episode, we go deep into pretty much how money works, and then it transitions into what is hard money and how does that function with real estate deals. Today, I think we're going to be talking more about if you are using hard money loans, or if you haven't yet, all the fees and stuff to expect.
Yeah.
And why they need to charge you certain amounts.
Yeah. And that's an important point, because, hard money isn't just like we give you a loan, you get money and do deal. It's like there's so many more pieces in that.
So many more.
So many more.
It's a very risky thing to do. It's a risky thing to lend money to real estate investors to do fix and flips or short-term investments, especially if that person is new.
Right. And, with many, just like you're getting a normal loan, there's a lot of risk with doing that too. The bank has to associate, like, how much is this risk worth? And that's basically what a hard money lender does. They have to say, like, okay, how much is this risk worth? Typically, we are taking on more distressed properties and more problem properties, so the risk is higher.
Yeah. And in my experience, I've seen a lot of newer real estate investors that are brand new that get into house flipping. It is not uncommon at all to have them lose money on their first or second deal. First or second deal, in their first 5 or so, they're usually losing money somewhere.
Right.
Because they just don't know what to anticipate when it comes to every little roadblock that they're going to hit flipping a house. They don't understand, unless they have a really deep knowledge of construction, just how much the construction plays into things. And then not only that, the holding costs and the timing. If you can't get things done in a certain amount of time, the clock is the biggest killer of your profit.
Right.
Sometimes.
Every day you're on your property costs you that much more.
Yeah, and we'll get into that, the reason whys and stuff. But
I remember that, though. Honestly, like, on my first flip, like, I think it was the one we did on Violet.
Yeah.
And every time a fee would come in, I'm like, why is this happening? And, like, I was kind of high anxiety on that one. Like, why is all this stuff happening? And now it just happens, and I'm like,
right.
Okay, we keep
going.
But on
that one, we were safe, I think.
No, we were very safe, of course.
We went extremely over budget, but we bought it right. We got a good deal.
Yeah.
And we still, in the end, we kept it as a rental because it didn't go well as a flip. And then in the very end, when we actually sold it, we made money.
Yeah. It was a rental, and then it wasn't getting rented.
Yeah,
it was getting rented, but we were getting paid for it.
And then those tenants are like, you know what? All this money that we pay every month, how about we stop it?
Yeah, it'd be fun. In my mind, I think it'd be more fun to not pay this. And our
property manager's like,
okay.
Oh yeah, we forgot to tell you.
Cool,
they weren't paying rent, but they were working on it.
And that's why you always check your books, ladies and gentlemen.
Yeah, we learned a lot on that.
We did. It was good.
Rotting trusses. That was the theme of that house.
Yeah.
It really lived up to its name, the moist home.
It did. That home was very moist. Pulling out that insulation from the ceiling was one of the most disgusting things I've ever done.
Yeah. And it was the 8th most disgusting thing I've ever heard about.
Yeah. Pretty gross.
Okay, so hard money. This is the 2.0, ladies and gentlemen. This is the real costs, what to expect, and how to get approved on hard money loans for real estate investing, primarily flipping homes or doing the BRRRR strategy or some sort of shorter term investment strategy. And we're going to focus mostly on residential because that's where most of the game is, and that's where most of the listeners are, I believe. Okay, so quick recap. There was another episode again. Just go to our page if you want to hear about that one first. Go to any of our podcast platforms. Just type in Hard Money. You're going to find one. I think it was season 3 or so.
Yeah, we talked about it a few times.
Hard Money episode. But we really get into the first 15 minutes of it is like just how money works in society and stuff. I thought it was pretty cool.
Yeah.
So. Again, who typically uses hard money? It's fix and flippers, BRRRR investors, the people that buy a property at a discount that needs massive improvements sometimes, and they need a short-term loan before they make all those improvements, and then they're going to keep the property and then refinance it, and then refinance out of that hard money loan. So,
the other people I would say that would need hard money are the people that need bridge loans, honestly.
Yeah.
The people that are like, okay, I've got this project under contract, but it's not closing until X, but I need the funds for it by here. And then we can kind of provide some sort of short-term solution in the meantime for that.
Yeah. And another part of the recap, in case you didn't get the first one, and if you're still unsure how hard money loans work, they actually work almost identical to normal loans when you get a house on real estate. Just the qualifications and the speed of it is a little bit different.
Yep.
And the fees and stuff. But if you have a house and you already have a loan or something like that, and you want hard money to help you fix it up or something, that's not what this is.
Right.
This is a new loan for a first position lien on a property. And the title company is going to be working with this hard money lender and reviewing docs just like a normal loan. And it's going to be recorded as a deed of trust.
Yep.
And
in
primarily in Idaho, and primarily it's going to be in first position.
Yep.
Sometimes they may take a second position on one of your rental properties for additional collateral if you wanted to play that game, where you come in with less cash out of pocket.
Right.
Zero sometimes cash.
But the underlying asset is still a first position lien, typically, that they're lending on, correct?
Yeah, the subject property, the house that you're going to fix and flip, that typically needs a first position lien with a hard money lender.
And why is that, Nick?
Well, simply it's the risk, and it's the property itself is going to securitize the loan versus your credit score.
Yep, exactly.
So and they call it a hard money loan because it's a loan against the hard asset. So it's asset based lending versus your personal credit score. Now your personal credit and your experience is all definitely calculated in.
We definitely take a look at
the
that.
approval. That somebody who's brand new at this is going to be looked at with a much finer, microscope to see if they have the resources to handle all the things that they're not going to anticipate.
Right.
Fixing and flipping a home.
And those are conversations we have all the time, honestly, with first-time or second-time hard money users. Like, okay, do you have the resources to keep this project going?
Yeah. Do you have the extra funds?
Right.
When things don't go your way? Because they're not going to go your way.
Right. A lot of times, a first-time home buyer or a first-time home flipper, they're going to try to throw all their cash at it. And I'm like, I try not to have you do that. If you can have some sort of other resources, whether you have a partner or, additional bank funds or you're an emergency fund, just don't use all your cash on your primary down payment because you will go broke very quick in this business.
Yeah. So you always need some sort of skin in the game if you're newer at this. The majority of hard money lenders that have 2 brain cells or more are going to want some sort of skin in the game from a newer investor. But maybe not so much from an investor who's done it, 10 or 20 or 100 times.
Yeah.
Because maybe they have a trust built up or they've done it multiple times and they kind of know what they're doing and typically they're getting better deals under contract. So also a huge factor is the deal that you get.
Yeah.
Is it a discounted deal? Like if the lender had to foreclose on you because you just abandoned the project or something like that, would they lose money if they had to take it over? And, 99 out of 100 times, they do not want to lose money.
Right.
Unless you're dealing with one of the weirdos.
Right.
There's very few unsavvy hard money lenders out there.
Yeah. There's a couple people who claim to be hard money lenders that are not savvy.
Right.
You know, people that just like lend and they're like, yeah, sure, I'll lend, but they don't really take.
They're new at it.
Right.
They don't really know real estate themselves, or they haven't flipped homes before.
Right.
That's something you actually got to watch out for.
Yeah.
If you're newer flipper and somebody's offering to lend you money and they have zero experience themselves, like, red flag.
Yeah.
Because usually your hard money lender is one of your best sources of due diligence, because they're going to do the due diligence as well on this property, not just you. They're not going to just rely on your due diligence.
Right.
They're going to do their own due diligence.
Yeah.
And make sure that this property is a good deal.
Yeah.
Good deal for them too. And what makes it even a better deal for them is more cash that you put into it up front with a down payment.
Right.
Because you're going to lower the loan to value.
Right. And I remember that the first time I actually used my own personal funds to do a hard money loan, I did it for the Smelterville property for the property chicks. You know, we did not know what we were doing back then.
Right.
It ended up working out, of course, because we were like, and this is how we analyzed it. We just could have gotten a little bit more money out of the deal, but we said, like, if this thing like completely fails right now, we bought a house for $120,000. That's worth $200. That's a safe deal for me.
Right.
Right. But we didn't require any money down. We didn't we didn't require a lot other than guaranteed interest of 12 months, and they got the project done, I think, in 4 months. So
yeah,
we came out.
So
ahead.
if a similar deal was brought to you by people that were new at flipping, because they were new at flipping too.
Yeah, absolutely.
It was like their first deal that they were going to actually close on, not just wholesale. So if that happened again with a newer investor that brought you a deal, would you just give them a 100% loan like that?
No, sir.
No, even though it worked out well.
It worked out well, yes. And that was, again, because we were in a very rising market at that time.
Yeah.
It was just like right after COVID, if I'm not mistaken. Right? Is that when it was?
It was like 2021.
Yeah, and the market was like on a very high uptick.
And there was no signs of it slowing down.
No. That one, and it was, again, this one thing, like, even if they failed at it, we were in a first position lien. This was documented on our loan. So if they failed, we would take the property back, and we would have our first investment property. Like cool. If you fail, we still get an investment here.
Right.
And that's what made it sound appealing. But yeah, definitely next time, no zero down.
Right. Yeah. It worked out well because they did what they said they were going to do.
No,
but that's not always the case.
Exactly.
Like, what if the market switched and then they didn't have the funds to finish or do whatever? And some people just walk away at that point.
Yeah.
Not everybody.
Yeah.
But I've definitely seen people walk away from real estate once things get a little tough.
Yep.
And
especially if there's no, if they don't have any skin in the game,
yes.
They are definitely more apt to be like, you take it. I don't really need it. And
100%.
Yeah.
Yeah, that's definitely the truth. With the best people, with the best intentions.
Oh, yeah, absolutely.
Too. If they have zero skin in the game on a real estate investment, I've seen, even some of my best friends just walk away.
Yeah.
Because, no harm, no foul.
Right.
In their head.
And again, that was such a sweet deal because they did what they said they were going to do. We made $12,000 in like 3 months or 4 months or something like that, based off of our HELOC, and that was all just, that's all profit.
Right. Okay. So what do hard money lenders typically look for? Credit versus experience, deal quality, that kind of stuff. Okay. So sometimes they look for, they call them the 5 C's.
Yep.
Some of these lenders, some lenders have no idea what that means.
Yeah.
But they look for they look at your credit, they look at your cash, they look at your credentials.
Yep.
Hey, quick commercial break here. Thank you so much for listening to this podcast. I really do appreciate it. If you want to give back, let me help you buy a house, or I can help you sell a house. It's the only way I make money when I'm not investing in real estate. I don't make money on this podcast or the events I do, but I do make money only when I help people buy and sell houses. So if you're looking for your next investment and you're here in North Idaho, I want to help you personally. If you are not in North Idaho, I can still help you out. I have a vast network of referral partners all across the country, and I can find the right real estate investor savvy agent for you so you don't have to. It doesn't cost you a thing. Thank you for your support. Back to the show. Your character. And what was the fifth one?
Collateral?
Collateral. Yeah, that's another one too.
Yep.
Good job.
Thanks.
So for a lender that's dealing with a new borrower, and let me tell you something too. Most hard money lenders that I see, or most deals that I see, like the majority of them are with repeat borrowers.
Yep.
They're not always dealing with newbies.
Right. Most of the people who are doing business continue doing business.
Seems like 80% of the lenders out, 80% of the lenders out there, 80% of their business is all repeat borrowers.
It's that 80-20
so they
rule.
don't have to they can skip half the due diligence of vetting out their clients because they already know they've already got a proven track record. Like, I remember when I got my first hard money loan about 11 years ago or so, I had to send a screenshot of what my credit score was, to kind of give them an idea what was in our bank account. And never again was any of that documentation ever asked for.
Sure.
And this is imagine going to get a loan for real estate and never having to show what's in your bank account, your credit, none of that. That's a pretty cool thing about hard money.
Yeah.
When I want to go get a loan, I show them the deal. I show them what LLC I'd like to use.
Yep.
I show them what kind of collateral that I may have to sweeten the loan, which we'll get into. But collateral can be used to sweeten the loan.
Yep.
Or any cash that I may be bringing to the table or bringing to the renovation. And I just give them those things. And then, of course, what is the property worth as is? What should it be worth fixed up? How much is it going to take to get that fixed up? Where are those funds going to come from?
Right.
And how are we going to do it? How long is it going to take? That way, a lender can look, and in 5 minutes, they'll know what is their rate of return going to be, approximately, because they always want to try to get a cash on cash. Most of these lenders, greater than 10% annually, and a lot of them are probably making closer to 16%
with fees and stuff.
Because they're recycling their loans. They want to do loans. They want to do multiple loans.
Yep. They want their money moving. If your money's sitting in the bank, and we talked about this last week, it's basically losing money. So a lot of times hard money lenders, whether they're a company or a private person, they just want to keep their money moving. And the more they can recycle that money, the more they can collect on fees and the more they can actually bring in.
Yeah. And remember, a lot of these hard money lenders, they're just people. They're not big. Sometimes they're big institutions.
They are. Yeah.
But most of the time, you're just dealing with people that have experience in real estate and that don't want to go and flip houses anymore to make their money or, go do the dirty work.
Right.
They'd rather just look at some deals and throw their money and put their money to work. While they enjoy their lifestyle or they may even have a job.
Yeah.
Or they're just retired.
Yeah.
But here's some of the fees to anticipate or watch out for. First, you've got origination points.
Yep.
A point is a percentage of the loan amount.
Right. So 1 point equals 1%. Correct.
Yep.
Okay.
So if you go get a loan on a $200,000, or if you get a $200,000 loan on real estate with hard money, if the lender's saying 3 points, basically take 3 multiplied by the loan amount. Divided by 12. Oh, sorry. That's going to be way complicated.
Don't do that.
It's going to be $6,000.
Yeah, take 200,000 and times it by 0.03, and that is your number.
Yeah. Or if you want to do it in your head, it's just what is 1% of 200 grand?
Right.
That's 2,000. And if you have 3 of those, multiply it by 3. That's $6,000. So that's an upfront fee for doing the loan. Now, that's different from an underwriting fee, processing fee, admin fee, appraisals, draw fees, extension fees, reconveyance fees, penalties, the annual interest.
Right.
Those are all things that you got to be aware of.
Title fees.
Yeah, so that's different.
Yeah.
So this is all associated with the hard money loan. There's also, there's another title fee. You're right. Mortgage title insurance.
Yep. You got to get insurance.
Not even on this example that ChatGPT put up here.
Yeah.
But that's an expense of getting a loan through the title company. They have to do an extra insurance above and beyond for the lender that the borrower pays for. Could be an extra $1,000.
Right.
But it's all these things that you got to heavily consider when you're doing your due diligence. It doesn't mean don't get a hard money loan. It just means be aware of what all these fees are so you can have a realistic expectation on what is it going to cost to get a hard money loan versus maybe just a partner.
Yeah, and there's also lender insurance fees, I believe. So you can get a lender's insurance policy. I'm not sure if our hard money lenders do that, but a lot of hard money lenders have that fee built in as well.
Yeah.
So that just says basically if you don't work on your loan, your loan is actually insured. So it's an insurance policy for the loan itself.
Yeah. More commonly in conventional loans.
Yeah.
I don't see them as much in hard money, but I guess that's something you could.
They are. I see them every now and then, but
Yeah. So interest rates. Interest rates, typical, it's 2025. They haven't changed much at all in the since I've been in real estate for a real estate investor for the last 11 years or so. They are still somewhere between like on the low end 8%.
yeah, that's low.
And on the high end, probably the highest it typically sees 13, 14%.
That's a very good range. I think a more common range, though, is like the 9 to 11.
Yeah, 9 to 11.
Yeah, that's like your more common, but your extremes definitely like the 8 to 14 sounds pretty accurate.
And even me, with all the experience I have, I still pay about 10% on every loan I do.
Yeah.
I know what my hard money lenders are trying to get for returns,
Right.
and I just anticipate that. And with almost every hard money lender I've dealt with, unless I'm looking at like a longer loan, I typically don't get under 10%.
Right.
But we've had like 8% before.
Yeah.
On like more of like a 5-year.
Yeah, on a 5-year note we did.
Note. But if for a shorter term, they typically want because it takes some effort to put these deals together. So they're especially if you're doing them short of a year.
Yeah, and I will say I've seen some of my clients come to me and say, like, well, this guy's offering me 4% loan, this guy's offering me 3% loan. Like, when I hear that, I think it's an uneducated lender, to be honest with you. Like
4%
yeah,
annually.
Yeah.
Oh, I've never heard of that.
Right, I'm like,
for a hard money loan,
go with it. But also, like, the people
Yeah.
who are offering 4% don't understand real estate.
yeah,
and they don't
pay
understand
attention to all the other fees that
Right.
might be involved.
And that's something too, because like I've analyzed a lot of deals, and people come back and say like, well, this guy's offering it at 5.6. I'm like, you should look at those fees, because honestly, there's a big difference on fee structure. This one happened to be 6 months later. I think it was a point every month he was late. Instead of like a 1 point extension for a year,
On top.
it was a 1 point fee for every month he was late after a 6-month loan.
Okay.
And that ate into his profits, right?
Oh, yeah,
and I'm
for
like,
sure.
you just got to look at these numbers and look at the whole terms and conditions before you say yes to a thing.
Yeah. You know what can really get you if you go over is maturity late fees.
Maturity late fees, yep.
I mean, they could be like 10% sometimes
Yeah.
of the actual loan amount. Huge fees.
Oh, yeah.
For going over. So you got to watch out. But yeah, interest rates, typically 10%.
Yeah.
And
And that makes it easy. So when you are analyzing deals, just plan for 10% annualized on your spreadsheet of what you're expecting to pay.
Yeah. So here's an example. Oh, thank you.
You're welcome.
Okay. So Sarah gets an interest rate of 10% on $210,000.
Shout out to you, Sarah.
Good job, Sarah. In this example, that's $21,000 a year in interest. Now, not points or anything else. This is just the
Interest
annual
only.
interest.
Yep.
It's about $1,750 a month. If she holds the property for 6 months, she'll pay $10,500 in interest.
So half of that 21K, yep.
Yep. And let's say, on that, let's say the underwriter charges a processing fee of $1,500. Let's say that she pays 3 points, which is common on a 210. That's $6,300 up front.
Is the points added to the purchase price, or is it added to the fees on top of the fees? So once you get like your loan insurance.
So nothing's ever added to the purchase price.
Yeah.
It's just, here's your purchase price. Here's all the other things on your statement.
Right.
But is it charged up front? Is that what you
No,
mean?
what I'm asking is, so like you've got your purchase price of $210, right?
Yeah.
And then
No. So that's her loan amount.
Okay.
Loan amount is $210.
Okay.
Doesn't actually show what. Let's say she's in this example, it doesn't even say what she's buying the property for. But let's say $250,000.
Okay, sure, $250,000. So you take $250,000, and then you take 3% of that for your points. That would be your points, correct? Not with all the other fees built in.
3% of whatever the loan amount.
Whatever
that
the
she's
loan is
asking.
not. That's I know that. I'm just trying to clarify it for other people.
No. It's very confusing. Trust me, if you guys haven't done this before,
It's just how you analyze
are-
the deals, right? Because
Yeah.
all the numbers they're different.
it depends on how much money you're asking for. That's how much all the fees are generated off of.
Yeah.
So the more leveraged you are, the bigger the loan is, the bigger the fees.
Yep, checks out.
Which not everybody thinks about that,
Right.
honestly, but it's just like you can get if you have a good amount of cash, you can still go get a hard money loan and maybe just get it for half of what most people would do.
Yeah.
That way you're spending half the fees.
Right. If that's what you're worried about, fees. But again, this is just another way of leveraging. So it just depends on what your position is and where you're at in life. You may want to come in with a little money down. You may want to come in with a lot of money down and try to get some better fees.
Yeah. So with outside the points up front and the annual interest, some lenders, not all lenders, but some lenders will also charge an underwriting or a processing fee. I know, like Doug, if we're using Sam, I know I can predict an extra $300 for Sam helping out with transacting, and which is actually on the way lower end of these kind of fees, because some lenders will charge $1,000 to $2,000, $1,500, somewhere in there. Yeah. For a processing fee, and that's to have somebody, coordinate all the wires and make sure, look over the docs and real basic admin stuff.
Yeah. It's nice to have, though, for sure. Like, I love the peace of mind of having that stuff just taken care of, and then I don't have to do it in my own due diligence, too.
Yeah. Some lenders may require a broker's price opinion or a full appraisal.
Yeah.
Which, that can be a few $100 to $750, something like that.
When do you think they would require a full appraisal or a broker's price opinion?
In my experience, they usually require an appraisal when it's tough to justify the costs.
Yes. Yep.
When they're you just don't have good enough comps to have a full confidence in an after repair value.
Right. And then this is an appraiser,
or an as is value.
Right. And as an appraiser, they're just going to give you an as is value, right? Or are they going to give you an after repair value?
You can ask for an ARV as well.
Oh, you can? Okay, cool.
Yeah, it's like an additional option.
Sure. Yeah. Additional option means additional cash.
A little bit, yeah.
Yeah. Cool.
But in appraisal, and then a broker's price opinion is typically, it's free for a broker to do, but sometimes they charge.
Right.
Sometimes they expect to be compensated. I've done BPOs for many lenders for many loans.
Yep.
I don't think I've ever been paid.
Yeah.
I think Pacific Mortgage Center, they offered to pay me doing a few, and I used to do them for them, and they never paid me. And they always said, "Oh yeah, we're gonna have checks put in the mail." It was silly. I don't know why I ever bothered with them, but they just never actually paid me for any of that work.
You live and learn.
But the funny thing is, they charged their borrower for it. They charged the borrower for work that I did, and they never paid me.
Yeah.
Shout out to you guys, Pacific Mortgage Center.
Shout out in quotes.
Okay, draw fees. If you have a construction budget that goes to an escrow company. You have a few fees here. You have fees to set up the escrow.
Yep.
With an escrow department, like we work with Panhandle Escrow a lot and Allegro Escrow a lot. Allegro is in Spokane Valley. Panhandle's up in Sandpoint.
Yep.
These are separate companies outside the title company. And sometimes the title company can do this too. I don't know why they don't just use title companies, but because they also have long-term escrow. Right. But it's a place where they're going to send the rehab money and just set up the loans anyway.
Right. It's going to be set up through escrow anyway.
A servicer to collect payments.
Yep.
And maybe disperse construction money. And if you have a $50,000 or $100,000 budget to work on a property, every time you ask for money, typically you're going to get fees, 75 to 150 draw fees charged by either the escrow company and or the lender.
Yep.
So you gotta just consider that if you're going to get 4 draws. I mean, that could be $600.
Right. And the escrow company, they just basically just use the note, and that's what they use to go forward, right?
Yeah, they're going to use that, but they also have their own schedule of fees that they charge, and the lenders never pay for anything.
Yeah, why would they? Why would they?
The borrower always pays for everything, so just keep this in mind. Whether you think it's fair or not, that's just the way this world.
They're
works.
not going to spend $1,200 getting set up on escrow if it's you that needs to make payments to them. That's just a fee you need to pay, unfortunately. But how much does that typically cost to set up everything through escrow or get a draw account?
A couple $100.
Yeah, it's really not that bad.
But it all adds up.
It does. It does.
That's why you got to know what all these fees are because they do add up. And then the last thing you want at the end of the day is to expect a $50,000 profit.
Yep.
And then you're like, why did I only make 40?
Yeah. Why did I make 33?
What happened? Like I don't get it. I thought we were on budget and blah 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 blah. How did this happen? Because there's fees everywhere.
Yeah.
They're like mosquito bites when you go camping.
Right.
Just anticipate them.
Yeah. It's just how the business works, unfortunately.
Yeah. So bring your bug spray, and your bug spray would be build in this before you ever go make offers on properties.
Right.
Build this into your budget.
Now, I don't want to derail us too much, but how should somebody build this in advance without knowing these numbers?
Well, listen to this podcast until the end because we're going to give examples. Well, this one's almost done.
Yeah.
So there's extension fees if you go over your time. That usually around 1 point, sometimes a lot more.
Yes, but like I said earlier, yeah.
And make sure you know this ahead of time. Make sure it's in your note that if you go past your 6 month or 12 month or 18 month or whatever your loan length is, know how much it costs to extend if you have to, or if you even have that option.
Yeah. Read your contract.
Yep.
And make sure you ask that question.
Yeah.
Even when you're just analyzing deals, ask your hard money lender, like, hey, if I end up going over, what happens?
Yeah. And do you have to ask for it in advance before that deadline?
Yeah.
Or is there a maturity late fee all of a sudden that gets triggered if you don't, which can be extremely expensive? You know, like on a $300,000 loan, that could be 30 grand.
Yeah. There goes your profits. Bye-bye.
Yeah. So you just got to be 100% aware of all the fees involved. And you just don't know until you've done a few of these.
Yeah.
So, yeah. Let's say, you know, Sarah... also, let's skip that example where she goes over. But
Okay.
just know, you know, it could cost a point if you go over.
Could cost more, too, so...
Yep. So there's also these things called reconveyance, which some lenders charge a fee for. I remember on my first hard money loan ever, it was kind of it wasn't a skinny deal, but I was very upset by every fee because I was new to it.
Right.
And that's how newbies get upset.
Yeah.
And I was not unique. I was also upset every time I got charged a fee, and I'm like, why?
My $300.
Yeah. And then even at the end, when we thought we were all done and we collected our money, all of a sudden there was another fee of reconveyance fee of $600. I'm like, what's this $600? I didn't even know what a reconveyance was, but it's like, oh, this is just the fee that we just, you know, it's like a payoff fee. There's payoff fees too.
Yeah. You pay off your loan, surprise, you owe us money.
Yeah. And there's fees that the escrow company will charge to give you a payoff quote.
Yeah.
So just know this, and this is a good rule of thumb. You add up all these fees together on Sarah's loan, you know, 3 points up front, you know, underwriting fee, appraisal fee. Let's say she just does 6 months. 6 months of interest at 10%. She does some draws. She has a renovation. There's a reconveyance. Let's say she doesn't get charged any other fees. She was well behaved. She's still spending 20 grand on a 6 month loan.
Yep.
So
That's not even including the down payment. That's just fees for having the loan. Just so everyone's...
Yeah, down payment is different.
Yeah,
down
I know.
payment
It is.
you know, this is just your skin in the game.
Right.
That doesn't necessarily mean that money's gone. It's just in the deal.
Yeah, these numbers at $19,950, that's the numbers that hypothetically Sarah would have after the loan was done.
Yep.
And what she actually paid for having the loan.
Yeah. So just keep in mind, she didn't go a full year, so she's not going to be charged that full 10% annual, but there's still about 10% in fees. For this, when you consider underwriting, appraisal, draw fees, reconveyance, those other kind of things added up to all of a sudden you're back at 20 grand.
Yep.
So if a project's going to take about 6 months, just anticipate 10% of your loan amount is going to be in fees.
Sure.
Just a quick rule of thumb.
Yeah.
You don't have to have every little thing broken down, but we just broke down this, and that's about what it is.
Yeah.
Now here's why hard money lenders, here's their goal. They are putting their money instead of in an index fund or something easy. They just click a button and they don't have to think about it.
Like Doge.
You know, something. Yep. Doge. Whatever. You know, they can make 5% in a money market accounts, or you can make 10% in the stock market most years.
Yeah.
Or index funds or whatever. Now, why would they do this hard money loan and only make 10%? And there's all this risk that comes with it, and all this babysitting and due diligence, and talking, you know, many hours on a deal, and like driving to the house and looking it over and all this stuff.
Yeah.
You don't do that when you buy stocks. You don't drive to Tesla and check out their factory and be like, I don't know.
I wish I could.
I recommend you guys do this.
I'm part owner here. Excuse me. I just want to say.
Yeah. So the lender's very involved. But if they can recycle their cash a couple times a year, they could be making like 16% cash on cash returns.
Yeah.
If that makes sense to y'all out there, because they're not, if they are only in a 6-month loan, they're not going to collect that full 10%. But with the points, and with the not necessarily the other charges that you see, because that goes to other parties.
Right. Yeah, that's not exactly their
They're
money.
really just getting the interest and the points.
Yeah.
That's all they're really getting. And if they can recycle their money twice in a year, they're going to make about 16%,
right,
or so.
Yeah,
I mean,
you think you're getting your 10% annualized, and you're getting your 3 points, which is typically 3%, and then you do that twice a year, so that 3% doubles basically.
Yeah.
So yeah, you're getting around 16% if they can get a deal moving every 6 months with that particular money, of course.
So here's a cool example for if you are sitting on, let's say, $500,000, and you want to be a hard money lender. And you want to be a little involved with this, maybe, hopefully you have some experience.
We can help you, by the way.
And you may not need our help, but maybe you do with our network.
We can help you with putting that money to use.
Yes.
We'll find a way for you to put $500,000 into real estate.
But let's say that you put together 6 loans a year because you can't put all your $500,000 into one deal. You want to diversify. Let's say you're making 2 loans for $200,000 and 1 loan for $100,000.
Cool.
Very common.
Sure. Yeah, absolutely.
$200,000, $200,000, $100,000.
I typically have different loans going out like that.
Yeah. And you do that twice. That's doing 1 loan every other month. 1 loan every other month, and you're recycling that $500,000. Assuming everything goes according to plan, you can easily make with these kind of random fees, with these fees at 10% and 3 points, about $80,000, $80,000 annually.
Okay.
If you have $500,000 sitting in the bank or in your retirement account or something like that, and you want to put together, you want to recycle that money twice in a year, you can anticipate making 70 to 100 grand, depending on what you do. But 80 grand in this example, is what we have. Now, the key is to build up enough relationships and to look at enough deals to do this, because you're not going to be lending on every deal you see.
Right. This is not a yes to everything, by the way. This is a yes to the ones that work.
You probably have to look at 4 deals to say yes to 1.
I would agree.
So, and then the ones that you say yes to don't always go through.
I would say it's probably more like, a 10% yes ratio.
Yeah, okay. So you have to look at 10 deals, just like an investor.
Yeah.
May look at 10 flips before they buy one. A lender may look at 10 potential loans before they say yes. I may have a skewed version on this, because every time I send something to a lender, I would say 3 out of 4 times it's a yes.
Yeah. But you built up that relationship and that trust, right? So like with your lenders and our lenders specifically, like they know who you are. They know what you're capable of. They know that you can handle a project of this caliber.
Right. But when I was starting, probably most loans that I wanted a lender to look at were a no.
Right.
And I didn't really know why. Until, but they were seeing things I wasn't at the time, because I just didn't have enough experience.
Right. They didn't know who you were, what you actually stood for, and now that you've proven that you can handle yourself in real estate, most of them are going to be very happy to lend to you.
Yeah. So yeah, I hope that was helpful.
Yeah.
Do you have any questions before we wrap up, Jeremy?
No real questions. Honestly, like I said, hard money is great for real estate investors looking to get into commercial or residential commercial. We don't lend on your own home, just so you know.
It's got to be just investment properties.
Yeah, and that's where it gets a little confusing, right? Because we're saying residential. Yes, we do lend on residential, but it cannot be an owner-occupied home.
Yeah, we lend commercial too.
We do lend commercial too, yes.
Yeah,
they're all commercial, but like when it's commercial residential, it gets a little weird. You know what I mean?
Yeah, we say residential just because that's so common to see 4 units or less.
Right,
4 units or less is like a fourplex, triplex, duplex, or a single family home,
right,
or a condo or a townhouse. That's all residential.
Yeah.
Anything 5 units or more, or if it's commercially zoned and there's a business running out of it, that's commercial. But what we can't lend on is your personal residence. That's Brett Shoemaker. He can do that.
Yeah.
Because we're not licensed.
We are not licensed.
And in the state of Idaho, you can do loans to, you can do commercial loans.
Yeah.
But you're like, wait, hold on. You just said residential. That's different.
It's different.
As long as it's non-owner occupied, if it's a rental property, a fix and flip, anything that's not your own, lending to somebody's to live in their house, you can do a loan to them in Idaho. Just make sure you're not taking advantage of them.
Right.
Or it's a predatory loan, nothing like that. But that's something that a lot of people don't even realize. You don't have to be licensed for this.
Yeah. And it's important to say, like, if you plan on living in a house that you have a hard money loan on, that's okay too. You know, what you just need to do is you need to finish your fix and flip, refinance into a conventional or FHA or whatever it is, and then once you're out of our loan, by all means, move into that property.
Hell yeah.
And a lot of times people do that too. They'll buy a fix and flip that they can buy, and then they basically get a discount for living in it, because then they're not trying not to take a profit. You know what I mean? No. But sometimes they do take a profit.
I know what you mean. I know what you mean.
You know what I mean. But not everyone does. And again, so hard money is great if you're trying to leverage into real estate and investing. Call your local hard money lenders if you have any questions.
It's a great tool. It's just expensive.
Yeah.
So you guys got to just keep that in mind. Make sure you know your numbers. Plan for it. That's why you got to look at the best deals and walk away from the rest.
Yeah.
That's what I do. And you know what? You may be thinking to yourself, okay, should I partner with people instead of doing hard money, or should I hard money instead of partners? Depends on how your situation, your cash. You know, actually, quite a bit. I would say more than half my deals are a combination of both.
Yeah,
we get a hard money loan, and I still have partners, partners that help out with the skin of the game.
Right.
Or
I'm making a hard money presentation right now, and one of my slides says, when should you use hard money? And I said specifically, it should be your first defense or your last resort.
Okay.
And I mean that, like, honestly, like, go in expecting to use hard money, or go in expecting to be like, okay, if all of my other options fails, I have hard money.
Yeah.
First defense or last resort. So go in, just be like, I'm getting a hard money loan, and just execute. It's pretty easy.
Yeah. The only time you really shouldn't be getting a hard money loan is when you plan to keep something long term.
Right.
And it's already in a condition to get a normal loan on.
Yeah. If you can just get a 6% conventional loan, do that.
If there's not going to be issues with the appraiser, like, hey, there's siding falling off the house, or there's crap building up, in the basement this high, right. Or it needs a new roof, or this portion of the property is on fire.
It happens.
That's good for hard money loans. Hard money, that's what it's meant for. It's meant for short-term solutions to fix long-term problems.
Yeah, typically distressed properties like you're talking about, and things where you can buy equity, or things that you can buy at a discount, like you said. Yeah. That's where hard money is going to really thrive, because again, your down payment's going to be a little bit higher. We've talked about this before. It's usually 70% ARV is kind of what we're looking to fund in that base ballpark, of course. So go in expecting these numbers, and then it just makes utilizing a hard money loan very easy.
Yeah, because remember, when you're fixing and flipping a house, and if you're mostly leveraged up, anticipate almost 10%, 10% of your loan amount gone in hard money fees. But then there's also other fees, these nasty real estate brokers that will charge you commissions, and title companies that will charge you title insurance to sell the house too. So you got to figure, sometimes on an average flip, 15 to 17% is going to be gone.
Yeah.
And that's why you need to build in that 30% margin that everybody always preaches about. If you ever been to a real estate seminar and you hear this 70% rule, that's why it's so important to be around 70%, so that you can make that 13 to 15% profit.
Yeah, exactly.
Because the others, half of that's going to be gone from those nasty hard money lenders and those nasty realtors and those nasty title people. Yeah. They all want their taste. And if they don't get their taste, you're not going to have a good day.
Right. And that's something to think about too when you sell your property, right? You're looking at 5 to 6% selling fees for your realtor, which is it's again, you just anticipate these things, and it becomes not a problem, because that's the normal.
Once you anticipate it, it's not an issue.
Right.
You just put it in your spreadsheet in advance. You don't do it every time. You just put it in your spreadsheet, and then you use that as a template. And then all you do is you put in your purchase price and how much is your renovation and what should you sell it for, and then. If it looks good at the bottom where
it's green,
if it's green, you go.
If it's red,
you offer lower.
Yeah, you figure out a money to get there, right?
Or you figure out what you're doing wrong.
And this is a good time to kind of plug your spreadsheet too, if that's okay.
Sure.
Is it still NorthIdahoREI.com?
That's it.
Okay, NorthIdahoREI.com. There's a pull tab on there that says spreadsheets, I think, right?
Free tools.
Free tools.
So NorthIdahoREI.com.
God, you need
click
a website
on
update.
Free tools. And then you can click on any of these calculators. It's just a spreadsheet, and they're already pre-filled in with a lot of this stuff.
Yeah. What's cool is it downloads it right to your computer, so you click it. Nick doesn't ask for your email or anything yet.
Yeah, working on it.
Working on it. We want your information, by the way. No, but it'll.
I'm like Elon Musk. I want your socials.
So give Nick your socials, blood types, mother's maiden names, any kind of passwords online you have. Go ahead and send them Nick's way as well.
Please.
No, but these tools are great, and you don't have to use Nick's calculators. There are plenty of them available, but Nick's does work very well. Actually, I will say that you've got pretty good calculators.
I like using it because it's all on one sheet, and you can put the your full scope of renovation in it too. But Chad Young actually has a really cool one, the Easy Home Buyer, where it actually does light up green or whatever. Like it's if it's a good deal.
I want a green for
which is kind of cool.
Yeah. Go on Fiverr and have somebody redo that.
We can get it reset. Yeah. But his already kind of has the hard money fees built into his spreadsheet, which is kind of cool. So I'm gonna update my spreadsheet. Okay. I'm gonna make it cool like Chad's.
Yeah. That's
Chad
great.
does everything better though.
Well, Chad, he's on TV with a commercial, man. I saw it the other day.
Commercial looked good.
Baller Media did it. I didn't do that.
Baller Media? Who's that?
Corey Jessman.
I hate him already.
You hate him more? Well, he did a good commercial. He made it look very spooky and good. It was a fun commercial.
It was pretty cool.
Yeah. But yeah, Chad Young. Shout out to Chad Young and
shout out to Chad Young. He knows his shit.
Shout out to Sarah for getting this loan in this.
Good job, Sarah.
Good job, Sarah.
All right. Hope you guys enjoyed that. Have a good day. Hope you learned something. Don't forget to do your push-ups after you pee every time, and call your mothers.
I couldn't have said it better myself. Thank you, Nick.
Thanks. Bye.
Thank you so much for checking out the Investor Shed podcast. If you enjoyed your time, make sure to leave a 5-star rating and review on Apple Podcasts and Spotify. Follow along on YouTube, TikTok, and Instagram at The Investor Shed for shorts and promos about each episode. Do you want to be a guest or know someone who has great real estate investing advice and stories? Reach out to us at theinvestorshed@gmail.com.